All eyes this morning are on the second inauguration of Donald Trump and what he says this week about tariffs and migration. The US dollar is firm and may rise even more with Trump's inauguration. China's GDP growth was stronger than expected in the December quarter, but was boosted by preloading of exports to the United States. That's coming up in our 5 Things in 5 minutes. And then in today's bonus deep dive interview, ANZ's head of Australian economics, Boyton, analyses the meaning of Donald Trump version 2.0 for Australia's economy.
There's upside to inflation from tariffs, but also downside to global growth. And then the two of those could well roughly balance each other out.
But first, in 5 and 5 with ANZ, the eyes of the world and global markets begin this week squarely on the White House and the second inauguration of Donald Trump as US president later today. The US dollar and US stocks have rallied strongly since Trump's election. But is there more to run for the world's reserve currency after its near 10% rise since election night? Or is it all priced in? ANZ FX strategist Felix Ryan says further US dollar strength is dependent on the US economy remaining exceptionally stronger than the rest of the world.
We do see that just the global growth fundamentals of many of the other major economies in the world, so looking at Europe and China, are still pretty soft. And we can contrast that pretty markedly with the developments in the US. So obviously just this year we've had a very strong set of data come out from the US, in particular looking at the employment data there. That means that the Federal Reserve will have to exercise a degree of caution when it comes to further easing, and that's been another tailwind for the dollar when we look at the interest rate outlook for, say, Europe, where the economy there is still struggling and we still see further easing there in the pipeline from the ECB. So all that's really been some sort of the medium to longer term picture supporting the US dollar, and does suggest there may be some risks around that to some more upside there.
As of 4 a.m. Sydney-Melbourne time, the US dollar index was up another 0.35% at its highest level since September 2022. The Aussie dollar starts the day down at 61.90 US cents, and the Kiwi is at 55.80, having neared a 15-year low in late trading on Friday of 55.63. Number 2. But what about the short term for global markets and currencies in particular? Here's Felix again.
There are some risks there around the uncertainty to do with trade policy, economic policy as well. And so we do see there potentially the impact of tariffs potentially making that global growth picture worse, or at least not helping it. And then that will be another added tailwind to the US dollar. You know, we did see from the change in trajectory in the US dollar around Trump 1.0, or Trump's first term, where initially the US dollar was weaker, but we did see that inflection in the dollar occur once we saw those tariffs come in early 2018 and impact the global growth picture. So all that's really underpinning our view of a strong, or at least a firm dollar for the first half of the year at the very least.
Number 3. China reported stronger than expected GDP growth figures on Friday that meant the authorities in Beijing were able to hit their 5% target for the year. Exactly. And despite being behind par for most of the year. ANZ's chief economist for Greater China, Raymond Yung, says the 5.4% growth reported in the fourth quarter from a year ago was mostly due to front-loading of factory exports before the inauguration of Donald Trump.
It's a factory-driven growth. Domestic consumption doesn't seem to be very, very strong, even with the stabilization measure. But because of the headwind from the external market, what China need to do this year is to boost domestic consumption. And this will be key economic driver for year of the snake.
Number 4. So that was last year, where China met its 5% growth target. What about 2025? Here's Raymond again on whether China can just keep relying on pumping more out of its factories.
The Chinese GDP number is production-based number. So that could be a chance that China is able to produce more, just like what we saw. The December industrial production was very strong and surprisingly strong, with 6.2% increase compared with the December in the previous year. That could have been the reason pushing the GDP number to a high number, but on the demand side, still weak. So if China really want to push growth in a sustainable way, they definitely need to improve the consumption appetite.
Number 5. In New Zealand, the Business New Zealand BNZ survey of manufacturing found the sector in contraction for the 22nd consecutive month in December. And that was the first time ever it has contracted for all 12 months of a calendar year. The previous worst was in the global financial crisis in 2009, with 9 months of contraction. But ANZ New Zealand economist Henry Russell says the worst is over.
It's very much much a reflection that the survey is asking questions for the respective month, where if you look at other pieces of high-frequency indicators which are telling a much more positive and upbeat story about the New Zealand economy, these tend to be more forward-looking. And conditions here and now are certainly still very challenging, but what other indicators are telling us is that a recovery is underway in the economy, although it is likely to be fairly gradual at first. And our expectation is that the economy and the manufacturing sector do return to growth in the fourth quarter to end 2024, and that's likely to pave the way for a more meaningful upswing in economic momentum through 2025.
Henry Russell there. Now, in today's deep dive interview, ANZ's Head of Australian Economics, Adam Boyton, looks at the risks for Australia of Trump 2.0.
With the inauguration of President Trump, I'd say that if I step back, Trump 1.0 really ended up having little direct impact on the Australian economy. Of course, it's early days as far as 2.0 is concerned. I guess on our base case at ANZ Research, yes, there'll be a rise in tariffs. When that filters through to Australia, I don't think it will have a significant impact. Probably one of the impacts we're seeing is responses by currencies in anticipation of that, and certainly the Australian dollar has been weaker this year against, say, the US dollar, but on a trade-weighted basis, still broadly within the range that's held for the past couple of years. So there's upside to inflation from tariffs, but also downside to global growth, and then the two of those could well roughly balance each other out. I think the other thing to be cognizant of is that markets have reassessed a bit just how much easing might be in the pipeline globally. That could flow through to Australia. And so often when we think about risks, we tend to think about downside risks. And the obvious downside risk is tariffs, uncertainty. What does that mean? It's possible that there are upside risks there too, and that could be a combination of fiscal stimulus measures around the globe, particularly if we do get some significant tax cuts potentially in the US. So look, I'd say, yes, there are global risks, but there are always global risks, and we'll have to see how those pan out. But certainly, I don't think I'd say I see storm clouds on the global horizon. If you're a weather forecaster, you might say partly cloudy, but possibility of sunny breaks.
Adam Boyton there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, January the 20th. Catch you tomorrow with a deeper dive into China's prospects in the Year of the Snake with Raymond Yung. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.